Your safest stocks may be exposing your money to a different kind of risk, the kind that grows quietly while prices appear stable. For decades, certain stocks carried a reputation: stable companies, reliable dividends, predictable earnings, utilities, consumer staples, healthcare giants. These companies rarely produced explosive returns, but they offered something investors valued more than excitement: safety. Owning them meant stability inside an unpredictable market. Their revenues were steady. Their products were essential. Their volatility remained low compared to aggressive growth stocks, so investors built entire portfolios around them. Retirees relied on their dividends. Fund managers used them to balance risk. Financial advisors described them as defensive anchors during market uncertainty. The belief became simple: when markets feel dangerous, move towards safety. But recently, something uncomfortable has begun appearing. The stocks designed to feel safe are starting to move in unfamiliar ways. Price swings appear larger than expected. Valuations stretch beyond historical norms. Dividend yields shrink even as prices rise. What once felt defensive now sometimes behaves unpredictably. At first, this looks temporary. Markets always move in cycles. Temporary volatility happens even to stable companies. But beneath those movements, a deeper structural shift has been forming. The visible effect appears slowly. The safest sectors attract enormous amounts of capital. Investors searching for stability migrate toward the same companies at the same time. Institutional funds increase allocations. Retirement portfolios concentrate around familiar names. Index funds automatically direct more money into large established firms. Demand rises continuously. Prices follow. The companies themselves may not change dramatically. Their earnings grow steadily. Their businesses remain predictable, but their valuations begin expanding faster than their underlying stability. This is where the invisible mechanism begins working. Safety itself becomes an asset class. Instead of buying companies purely for their profits, investors begin buying them for psychological protection. Capital flows not toward growth, but toward perceived reliability. That demand pushes prices upward. And when price rises faster than earnings, something subtle happens. The margin of safety quietly shrinks. Investors are now paying more money for the same predictable income. But the behavior continues because the motivation is emotional stability rather than financial efficiency. This creates a behavioral trap. The more uncertain markets feel, the more investors concentrate into the same defensive stocks. Demand increases further. Prices climb higher. Yields decline. The stocks feel safer precisely when their financial cushion is becoming thinner. Investors rarely notice this shift because the companies themselves still appear stable. The products still sell. The dividends still arrive. Nothing obvious looks broken. But the relationship between price and protection has quietly changed. Over time, this concentration produces another effect. When many investors depend on the same safe assets, those assets become sensitive to collective behavior. If large funds rebalance simultaneously, prices move quickly. If interest rates shift, defensive sectors react sharply. If economic expectations change, investors rotate capital elsewhere. Suddenly, the stocks designed to reduce volatility begin transmitting it. Not because the companies became weaker, because the market surrounding them became crowded. This is the structural lock-in. Investors seeking stability unintentionally create fragility. The more capital that flows into defensive stocks, the more their prices depend on continued demand. Their stability becomes conditional, and conditional safety behaves differently from fundamental safety. Yet most investors still approach these stocks with the same mindset that existed decades ago. Buy safe companies. Hold them long-term. Ignore short-term noise. The advice still sounds reasonable. It worked for generations. But the financial environment around that advice has evolved. Markets today move faster. Capital flows are larger. Index investing concentrates ownership into fewer companies. Algorithms react to macroeconomic signals within seconds. All of this increases the speed at which capital can enter and exit the same assets. So the definition of safe quietly changes. Safety once came from durable businesses. Now it often depends on the behavior of investors themselves. And investor behavior is rarely stable. This is where the identity collision begins. Most people believe they are reducing risk by choosing conservative investments. They avoid speculative assets. They diversify. They hold companies with long histories of reliable performance. These decisions feel responsible. They align with traditional financial wisdom. But those same choices often place investors inside the most crowded areas of the market. The safest names become the most heavily owned. And heavy ownership carries its own form of vulnerability. When everyone relies on the same stability, that stability becomes fragile. The system quietly transforms safety into dependence. Dependence on continued demand. Dependence on interest rate conditions. Dependence on market narratives that reinforce the belief in safety. The companies themselves may remain strong, but the financial ecosystem surrounding them becomes increasingly sensitive. Investors do not notice this shift immediately, because during calm periods, everything appears normal. Dividends arrive, prices move gradually, portfolios look stable, but the hidden pressure accumulates slowly beneath those calm surfaces. Then a small change occurs. Interest rates rise slightly. Capital seeks higher yields elsewhere. Large funds rebalance allocations. And suddenly, the safest assets begin adjusting quickly. Prices drop faster than expected, not because the companies failed, but because too many investors were relying on the same stability. This is the quiet cost of crowding. The moment safety becomes popular, its protection begins eroding. And once that process starts, reversing it becomes difficult. Investors cannot easily leave the same assets they entered together. Selling pressure creates further price movement, which creates further selling. Volatility spreads through the very assets designed to suppress it. The consequences extend beyond price charts. When investors lose confidence in defensive positions, their sense of security shifts. Portfolios once viewed as stable suddenly feel uncertain. Financial plans built around predictable returns begin looking fragile. Time becomes the invisible cost. Years spent trusting stability cannot be recovered easily. Capital tied to underperforming defensive assets misses other opportunities. Optionality narrows. Freedom quietly declines. This is not the dramatic collapse most people associate with financial risk. It is slower, more subtle. A quiet realization that the structure protecting your money may not behave the way it once did. And that realization spreads gradually across the market. Investors begin questioning what safety actually means. Companies remain stable, but prices react differently. Dividends still arrive, but yields feel smaller. Portfolios still look conservative, but volatility feels closer, which leads to a deeper recognition. Risk in modern markets is no longer defined only by the companies you own. It is shaped by how many others believe those companies are safe. And as more investors search for protection in the same places, the definition of safety continues shifting quietly beneath them, which means the next moment when safe stocks begin behaving unpredictably may not arrive as a sudden crisis. It may appear slowly inside the same portfolios that still feel stable today. For more long-form thinking about investing, incentives, and financial systems, subscribe to Finance Simplified.